Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
U.S. Interior Secretary Doug Burgam joins us now. Secretary Burgam, thank you so much for being with us. I want to start with just how important it is right now for the United States to increase energy supplies across the board, not just with drilling, but across the board in the face of the demand coming from AI.
Well, good morning, Lisa. Yes, it's absolutely essential, and this is part of the just announced national security plan that the White House has released. That security plan mentions energy 23 times. There's an entire section about energy dominance, and folks should think about energy dominance as the ability for the U.S. to sell energy to our friends and allies so they don't have to buy it from adversaries, particularly those adversaries that are either funding terrorism or are funding wars, actively funding war machines. And so it's core to the strategy right now, but it's also, as you've talked about on the show, is about with AI, because it never before in history have we been able to convert a kilowatt of electricity into intelligence. The demand for that, regardless of stock prices or stock movements, the demand for AI, for intelligence applied to every job, every company, every industry is going to continue to increase the demand for electricity around the world. The U.S. is an energy dominant country now, the largest oil producer in the world, largest LNG exporter in the world, and growing quickly. With that strategy, it bodes well for the future of the U.S., both in terms of peace and in terms of prosperity.
Secretary, I'm sure you're aware WTI is under $60 a barrel. What's the impetus for the oil and gas companies in the United States to continue drilling wells at this price level, which potentially could be a loss for them?
Well, I think one thing that we know that in the Trump administration, we're cutting red tape so rapidly. We think that, one of the early targets we had was cut 10% of the cost away from those producers just by cutting red tape. So if you think about, $60 today, it might be what $67 was a year ago because of our ability to take cost out for those producers. And there's example after example, whether it's from the EPA, the Department of Energy, Department of Interior, where we've been able to help reduce costs. And of course, this industry has been better than almost any in terms of gaining, productivity. The shale producers now drilling 3-mile laterals instead of 2-mile laterals, up to 4-mile laterals in many places. Offshore, we've seen examples overseas of people building 10-mile laterals when they're getting after the shale rock, all with the same small well pad on the surface. So, great for land management and great for energy production, and kudos to this industry. The entire shale revolution has occurred through innovation, and that innovation is going to continue. And with AI applied to that, it's going to get even better. So I see the leading companies are getting their costs down, even as demand is going up.
But Baker Hughes is talking about drilling rig activity has fallen 16% since Trump took office this year. The president loves to talk about drill, baby, drill. Do you expect that to change, those numbers to change next year?
Well, I think, again, I'd have to take a look at the numbers. When we talk about drilling activity in my home state of North Dakota, we had number of the well count was going down, but the miles of lateral productive rock could be going up. And so, analysts have got to make sure that they're actually keeping up with how fast this industry is changing, because we've got, again, record production occurring right now, and we expect to see records through 2026.
One area where you have seen price increases has been natural gas. Natural gas prices rising to the highest levels in the U.S. going back to 2022. And a real question on how much the U.S. can continue to export to places like Europe in the face of significantly higher prices here in the United States. How do you plan to sort of set policies so that the U.S. can be a big exporter to places like Europe while not allowing prices to go up so significantly in the future?
Well, again, the key is its supply and its infrastructure. We have places in the U.S. right now where, again, there's not one price for gas in America, as you know. I mean, even though we've got the markets and we've got Henry Hub, but we've got widely ranging prices. I mean, even in the difference of price in Pennsylvania versus in New England, because of the lack of natural gas pipelines that have been blocked into places like New England. And when we think about markets, you're talking about AI and the capital spend going against AI, where we're an AI factory where we're actually creating and manufacturing intelligence. Those plants are going to go to the places where states have low electricity prices, and policies are setting price, not just markets. And we've got policies in blue states around our country. California, you mentioned California. 63% of California's oil is being imported from foreign countries because of blocking of pipelines coming into that state. They have a record number of internal combustion cars in California. They have more internal combustion cars than any other state has cars. And yet 2 refineries have announced that they're shutting down in California because of policies, not because of lack of demand, not because of lack of consumers. And so what's going to happen? You're going to have oil tankers and refined products coming into San Francisco Bay and coming into Long Beach in record numbers in California because of policies. They will have higher gas prices than virtually any other state. So again, we have a strategy in America to help every state. The Trump administration wants to have low, affordable energy prices for everybody, whether it's heating your home or driving your car or producing electricity for AI. But we're going to need the collaboration from states to make sure. And if states don't want to collaborate on that, then you're going to see this $1 trillion of AI, a historic amount of spend, all going towards states that have pro-energy policies that drive down prices.
Secretary, we've seen a significant increase in energy costs, especially for individuals who live near data centers. How is the U.S. going to do both at once, both support these AI initiatives, but also make sure consumers' energy prices remain affordable?
Well, if you said on the show, I mean, the prices are in electricity are local, not national, and so there are the examples that you think we're driving that analysis right now, and we're going to be publishing that from the White House to the National Energy Dominance Council, the Department of Energy doing great work on that. But a lot of the higher prices that you're seeing are not related to the AI data centers. A lot of the data centers are going to be off the grid, behind the meter, and then adding more energy, and then putting some of that energy onto the grid. So we could be actually increasing the supply in some of those areas where we've got increased pricing. It's because of the policies they pursued the last 5 years of having unreliable, intermittent, and highly subsidized projects, including things like offshore wind, where people were spending $11 billion to create 1 gigawatt of intermittent, versus spending $1 or $2 billion to create 1 gigawatt of assured 7 by 24-hour power. So the policy choices of the last 5 years, driven by sometimes climate extremists, were the ones that are driving up the prices that you're seeing. I mean, electricity costs 3 times as much in New England as it does in North Dakota. That is not because of data centers. That's because of policies.
Stay with us. More Bloomberg surveillance coming up after this.
Kate Moore of Citi Wealth writing, we remain fully invested in equities on this nominal growth backdrop and prefer gold over long end duration as a hedge to risk given the upward pressure on rates. Kate, I am so pleased to say joins us now for more. Kate, good morning. Thank you for being with us. Good morning. So this has been a market that you've been cautious about for a lot of this year. You still see reasons that maybe the everything rally can't continue forever, but the tone has shifted. Why?
Okay, so it's not that I've been cautious. It's that we didn't aggressively add to risk because we prefer to take our exposure in large caps. And I continue to, even after seeing some of the small cap rally. I think most of that, and you kind of led into this a moment ago, has been around rate cut expectations. And relative to some others, we don't think the Fed should be cutting rates at every meeting from now until next June. I know some people are hoping for that and some pricing that in. And we think small companies desperately need that in order to really sustain a rally and to have better our earnings and fundamentals. So we prefer to take our risk in the large caps space. We've done quite well there, but it's not that we've been out of the equity market or been underweight in any way, shape, or form. We just want to be where the earnings are and where the free cash is and where we have visibility, and that served us really well this year.
So what you're saying is, it sounds like you don't buy that there is this truly durable rotation into small caps and to expand out of just where the leadership has been. Is that correct?
Yeah, I want to. And I know so many people have written their year ahead report saying, once again, same thing they did at this time last year. Next year is going to be a year of broadening. It's going to be a year of broadening in sectors. It's going to be a year of broadening in terms of regions. And I'm not a buyer of that today, this first week in December. And let me explain why. Because we are kind of later in the cycle. We are at a point where you can pick and choose whatever economic data you want to fit the narrative you want to tell about the overall macro and what policy might do to respond to that macro. And I think you have to be very anchored to fundamentals. And where we have visibility into fundamentals, where we can see earnings, where we know that companies have the ability to weather any kind of storm in the economy, whether that's a bit of inflation spike or a slightly weaker labor market or policy headwind, that's where we want to be anchored. And I think many investors will as well. You don't just rotate for the sake of rotation. You just don't buy the laggards for the sake of it. In fact, we have done a bunch of quantitative studies to show that when you employ that strategy, particularly after a full year of performance of kind of tech and comms, et cetera, you don't perform as well. Some of these things that are doing well deserve it, and we don't rotate for the sake of rotating.
But isn't the table set this time around better than it was last year, in the sense that the Fed looks likely to remain accommodative?
Yeah.
You have a deregulation push from this administration, and the trade policy uncertainty is now behind us.
Well, so let me say this. We are really constructive on the deregulatory side, and it's a reason we've been talking about the opportunity in banks. I realize I do work at a bank, but I also can be objective, and my job is to make my clients money in all parts of the cycle and in all sectors. So, yeah, I see the deregulatory side as a good tailwind for parts of the market and for the economy. On the trade side, much of the uncertainty is behind us, but not all. And I like to say we were past peak tariff shock, but we're still kind of working through what's going to happen with the IEEPA tariffs, which tariffs are going to be enduring, what will trade look like. Look, I'll be honest, I'm encouraged when the administration is pulling back or rolling back some of the tariffs they employed. I think that's I'd like to see a more moderate inflation environment, but we know that higher prices are still filtering into the costs and to the end prices that companies are charging consumers. So I don't think we're past the concern. I think people are tired of talking about it and want it to go away. But inflation, I think, is spicier than many are pricing in the market. That's a core view of mine.
Lisa and I have been talking about all week what the signal should be from the dollar stores and Walmart. Is it a good signal in the economy and the consumer, or is it actually a negative one?
I think it is a cautious signal. I think we are getting consumers who are continuing to spend. We like this, but they're continuing to spend in a way that is conscious of, brand. It's conscious of value, and it's conscious of where the best deals are. We all know how this went kind of over Black Friday and the following weekend. Consumers are, if they're in the big box stores, they're using their phones to price check at the same time. And we saw more people shopping online than in the stores than we have historically. Continued to see that trend, and that's largely because people are comparison pricing on prices. And I think that's a smart thing to do, but they are not stopping spending. But we do need to be recognize that we are at this later part of the cycle, that consumers are a bit fatigued. This has been a tough year. They don't feel many things are affordable, from the regular basket of goods to housing, et cetera. And we need to listen to that, and the administration needs to listen to that as well.
So you talk about how you are somewhat looking at the large caps to continue to outperform. You're not screamingly optimistic about the U.S. economy. At the same time, not seeing long duration as a hedge. I wonder how much this has to do with the glut of supply, not only coming from the Treasury market, but also from the corporate bond space, as it helps to finance a lot of the AI tech boom that we're seeing.
Yeah, so we've seen an uptick in some of the financing, obviously, for AI projects and AI adjacent projects and infrastructure. But it's not setting off any alarm bells for us. Frankly, on the duration side, the thing that we're most concerned about is that we are exhibiting very little fiscal discipline in the U.S. government. That is not a political statement that's true across both Republican and Democratic administrations, and that the rest of the world is kind of waking up to this, and that this is not a great picture over the medium term. Frankly, if we think inflation is going to be a little spicier, and we think that we're likely to get no fiscal discipline in 2026, the likelihood that bond yields stay where they are or move a little bit higher, that we're not going to get a lot of juice, I think is quite high. We prefer to hedge our long equity position with more gold at this point.
Well, I wonder where credit fits in with this. And I'm saying this after Warner Brothers and Netflix, their tie-up has been confirmed this morning. That deal is expected to close in 12 to 18 months. Netflix has been talking about using a lot of cash as well as buying shares. That is code for debt markets that are going to be financing this, since they don't have that cash on their balance sheets. At what point do you think that the credit market is going to experience some fatigue with the massive issuance it's seen, not only from AI, but from some of the other M&A activity that's come down the pipe?
Yeah, I mean, this is an excellent question, and actually something we've been spending a lot of time on our research side on this week, because we're asking ourselves, how much juice is there left in the credit market? We know spreads on the IG and the high yield side are close to the 15-year tights. It's great if you're a company that's issuing. It's not so great if you're looking for like a great total return from that asset class. And as asset allocators, that's what we're really examining. So while I'm not calling for any significant spike in defaults, we have to ask ourselves, relative to equities, can we get the returns that we need on a risk-adjusted basis from credit at this point? And we're less convinced. And we've been a little bit underweight relative to our index.
So if you're underweight credit,
but overweight equity,
but overweight equities, and you're underweight long duration,
and balancing out with gold,
mm-hmm. This is a new portfolio allocation. This looks like a different kind of model than pre-pandemic, the 60-40 type of allocation.
It absolutely is. And a big project we're also undergoing is really kind of rethinking how we construct portfolios in general for all of our clients. They need to be outcomes based and not just static based on a 60-40 benchmark. What part of the portfolio needs to be generating growth, income, and uncorrelated returns? And then where do the traditional asset classes and factor exposures fit into that? So this is a huge project for us, and we are really, really excited about where we'll take it.
Stay with us. More Bloomberg surveillance coming up after this.
Constance Hunter of Economist Intelligence saying a Hassett-led Fed could go in multiple directions, writing, if the Hassett who wrote about the deleterious effects of inflation shows up at the Fed, the markets should feel relieved. If his loyalty to the president shows up, markets may show concerns. Constance joins us now. Constance, great to see you. Thank you so much for being here. Yeah. I want to start with why we haven't seen more concern in markets yet, because ultimately, if you're looking to the market as a barometer of fear, you're not seeing any huge red flags.
No, you're seeing zero fear. And part of that could be that markets are looking sort of short term, right? They know that there's going to be another, or think that there's going to be another Fed rate cut in December. Also, it's the makeup of the Fed, right? The Fed was designed as an institution to be immune from political pressure. So whether you're talking about the terms of the governors, whether you're talking about the way the regional presidents are set up, so all of this is a very intricate timing game. I think the markets are betting on the fact that the Supreme Court will punt the decision to after February, and so therefore Lisa Cook will remain in place, right? That's really critical, because if you have a threshold of 5 or 4 governors, they can overrule the president's terms. So there's a lot going on in terms of timing, and I think the market is betting on a few things that will keep that independence in place regardless of who is Fed chair. But also, if you look at Kevin Hassett's work from before he joined the first Trump administration, it really centers on the importance of keeping inflation low, because the tax code is geared towards benefiting firms during periods of low inflation. Right. So it depends on which Kevin Hassett shows up.
Yeah, it depends on which economy shows up too, right? Because ultimately you're at the behest of the market and of the economy. Right now we're kind of flying in the dark because we aren't getting a lot of real-time data. We should have just gotten the non-farm payrolls report. Sorry. Newsflash, we're not getting it until December December 16th, but right now we are looking to September PCE report coming up in about 90 minutes time. I mean, what do they do with this? How do we understand whether inflation is the bigger problem or whether it's the labor market?
Well, we pretty much know what the PCE report is going to say with regard to inflation because a lot of that is derived from the CPI and the PPI. So we think it's about 2.9% for a headline, 0.22% for core. Those are both month-over-month numbers, right? The more interesting thing is going to be looking for any signals in the wage and income data. And so we are looking for a little bit of softness in the wage data, but that's going to give an indication of the strength of the labor market.
When you say which Kevin Hassett shows up, isn't he being chosen because the one that is going to be Donald Trump's chief marketer when it comes to the economy, isn't it going to be him that is going to listen to him when it comes to lower rates? Because that's the only reason why he's being chosen?
I don't think it's the only reason why he's being chosen. I mean, he is an economist who has a long track record of being in D.C., being a policymaker. He basically crafted the TCJA, and he was very influential in the CARES Act. So I think he's being chosen for those reasons. But remember, he's going to have to convince his fellow board members and the presidents who are going to be voting next year that his policy direction is the direction that the Fed needs to go in. And that is a big question mark. I mean, he's going to have to use a framework, and he's going to have to think about policy within that framework. And keep in mind, we have the benefits of the One Big Beautiful Bill Act coming, the delayed tax refunds. We're looking for over 3% GDP growth in the first quarter, about 3% in the second, and about 3% in the third. How do you cut rates into that environment?
Do you think that potentially the rebates we're going to get, the One Big Beautiful Bill, and the fact that this administration is talking about $2,000 checks is going to make the inflation picture that much harder for the Fed next year?
Well, the $2,000 checks, I think we need to put aside because who knows if they're going.
But they keep talking about it.
They do keep talking about it,
and it's a midterm election year.
Yes, fair enough. Yes, that would put more money in people's pockets, and it would be make them able to withstand price increases. Because I think what you've seen with the tariffs is a lot of concern about people's ability to handle price increases. Firms have absorbed some of that tariff increase. They've reduced hiring in order to sort of compensate for that. And so the question is, how much are they going to be able to pass on? It would stand to reason if people have more money in their pockets, companies are going to be able to pass on bigger price increases.
We're talking about a Federal Reserve that's set to ease policy, and we're talking about pain among the consumer base at the same time that Wall Street is talking about enthusiasm for mergers and acquisitions. We've been talking all morning about this deal of Netflix agreeing to buy Warner Brothers. We're talking about returns that are likely to be above 10% on the S&P next year. Is this a potential headwind or a tailwind for central bankers that are both looking for some sort of boost from consumption that will come with more of the wealth effect, but also could potentially be fueling froth in markets that seem pretty accommodative?
So it all comes down to productivity. Right? If we really are getting the productivity gains, and not just from, when we say AI, right, it's not just generative AI and ChatGPT, but the productivity gains from just regular AI, right, are still being diffused throughout the economy. And that is an important driver of productivity growth. So it really comes down to, are we in a period of enhanced productivity growth, in which case the markets are not excessively frothy, in which case the Fed has a lot more room to maneuver because ultimately that will help inflation. But there's going to be a lot of noise in the first and second quarter in the data, and it's going to be very difficult to interpret the underlying factors that are happening in the economy.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.